Hey there, welcome back already to the 17th chapter of the book. It's about the link between stocks and futures, and I just wrote down a couple of links which actually attract each other, and some which just totally are opposite to each other. So basically, these are the four sort of keywords which you really need to understand, because it gives some much more clearance in what is going on, really, because you can say, well, commodities and bonds don't attract each other because blah blah blah. But if you have a really good example, it's good. So I'll just create an example. So a bond is basically a loan from an investor to a borrower. So let's say you buy 10,000, or you sort of loan Tesla $10,000 with a 10% interest rate, or over a year. So after a year, you'll get your 10,000 back, and with another 10% on top of that, so you get 11,000 in total. So yeah, that's basically a bond. So now a commodity is a raw material, or like any primary agricultural product, like, I don't know, food, stuff that you need. So not necessarily what you need, but agricultural products. Those are commodities. And well, yeah, stocks. I'm sure stocks are quite familiar to you, but they're just kind of like sort of equity or security, which represents ownership of a fraction in the issuing corporation. So yeah, just again, let's say you buy Tesla stocks. Now you own Tesla, and it's not like it's different to a bond, because they don't need to pay you back after a year the same amount, but it could become worth less, and you know, then you'll lose money, but actually they'll lose money as well. So that's kind of you sort of own the company. You didn't loan anything out to the borrower. Now, utilities are actually also probably pretty similar, but the basic services for your home, so let's say the light and electricity and all that stuff. So you have gas, light, and that's one more. I don't know. Electricity? No, I don't know. Yeah, so those are utilities. So now let's actually get into the I actually like the opposite trend more. So let's start with similar trend, because I'd like to finish with opposite trend. So basically, these are the list of things which go in a similar trend to each other. So first of all, being is the S&P 500 cash index and the futures contract. So basically, this is a screenshot, or like a picture he put into the book. But here you can see basically the sort of less black line, sort of grayish line, as the futures contract and the 500 cash. And you can see that at the end of the year, they're actually near each other. There was a reason for it. I think it was because no, I don't know anymore. But there was a reason why they actually, towards the end of the year, they really get back, and maybe because the contracts most of the time end like near February or March. Like, could be the reason, but I'm not sure now. And I'll show you what you actually hear. So I'm just gonna put this in auto. So let's say we have this monthly of the S&P 500. This is actually the futures. And you might not see a big difference, but there is a small difference. You can just see how it reacts to it. And let's say we zoom into the daily. You can just see like a little bit of difference. I wasn't able to get like a line across to the other one, but I can make a picture anyway. But just put it here. But basically, it's really similar. It's like extremely similar. Not sure if this is showing up good. I guess you can kind of see it. Lower, higher. I'm not sure if you can see it, but it's really similar to each other. But it's just a bit tad different in prices. So yeah, that was it for the contracts. All right. Now, where did they go? Did I only have? Thought I had more pictures. Pretty sure I had more pictures. Why are they there? Why are you there? Sorry. Okay, I guess this is fine as well. A bit of a mess, but it's fine. So that's the difference between these ones. Now let's get into the bonds and stock prices. So why do these actually sort of attract each other? A bond is essentially a loan, right? So whenever the stock is doing great, it's probably measured at the overall I'd say the overall economy is doing pretty good. So bonds are then quite a safe investment to go on, because whenever the economy is not doing good, and let's say the price of the dollar actually increases, which means essentially the dollar is becoming worth less, because well, you can buy less for the same amount you had like a year ago. And you can see the same thing here, because well, if you can buy less stocks, you also can loan less money to a borrower. I get it's I'm not sure if I explain this clearly, but these ones are similar. Now let's get into this is so the utility index. Um, yeah, if everyone can pay their utilities, it's also probably a good sign that the economy is doing great. Um, let's say no one is able to buy their utilities, they'll probably cancel their bonds, or at least not buy new bonds anymore. So you can kind of see the similarities between why these move together, why it's always a healthy trend between them. Not sure if this is the correct one. This is, so this is a tech, and there's a lot of tech companies in the S&P 500. So basically, they are also a good indicator of what the overall economy is doing. Just a quick overview, and you can kind of see where it's going at that. Now we have, could be the same picture as well, actually. Oh no, never mind, treasury bonds. So these are the treasury bonds. Didn't really look into it, but yeah. So they started buying bonds and selling stocks. I guess they started selling Asian stocks maybe, and started buying American stocks because S&P 500 is American. Maybe, I'm not sure. I didn't really look into it, but it's there anyway. Oh, why can't I reach it? Okay. So right now we have this one. So these ones opposites actually, I think they're more a bit more interesting than the similar trends. So let's get started anyway. So with the commodities and bond prices. So why do these things opposite each other? Well, whenever commodities become more expensive, less people are going to be able to buy bonds. That's just, I guess that's just the explanation. There's not really, another reason. I think a great example is the one of cyclical stocks and consumer staples, which I'll actually get on now. I think it's this one. Yeah. So this is it was quite interesting to me, at least, because these basically mean cyclical stocks are things which are kind of, they're not like a first priority need for a human. They're like a car, or new furniture, like stuff like that. And then consumer staples are actually things you need on a daily basis, like food and electricity, like that stuff. So of course, when people are not able to buy electricity, they're not going to be able to afford a new car, right? So that's kind of that's why they move similarly, or actually in complete opposite of each other. So you could say right now the cyclical the consumer staples are extremely expensive, and this is a pretty good time to invest in cyclical stocks. Like, pick any stock, because basically the cyclical stocks, it's not the complete S&P 500, but it's closely relative, I guess, more to cyclical stocks. I guess Walmart is in there as well. It just cancels out a bit, but I feel like there's more cyclical stocks in S&P 500 than there are consumer staples. But that's just my opinion. I didn't back it up on anything. So here's the US dollar index on commodity markets. So of course, whenever the dollar is doing good, oh, actually, is this? Oh yeah, sorry, I thought I read it wrong. But of course, whenever the dollar is doing extremely good, you can look at it two ways, because you can say the dollar is doing good, and you could say, well, it's becoming worth less. Like, let's say, basically because of inflation. So I'm not sure what they mean. However, the dollar is doing good, but essentially, when the prices increase, or so the dollar increases, you're able to buy less for the same amount, because, well, you can buy less, right? It's just, you still have the same amount, but things become more expensive, so to speak. So that's why those move in opposite of each other, because let's say you put a 10,000 in Tesla for a loan, you're not going to be able to touch it for a year. And after a year, let's say it's only 2% inflation, well, you lost 200 euro. Is it 200? It's 2,000. No, never mind, it's 2,000. That. Oh no, sorry, it's 200. No, sorry, I made a mistake. It's 200 euro. It might not seem like a much, but you know, it's still something. And especially last year, I think it was like 9% inflation. That's insane. You know, that's like, it's huge. So yeah, that's why they upset each other. Now the last one is of course the dollar and the gold. I always like to look at the gold, and it was especially funny to see that it was really rising the last month. Have been doing really great, like especially since the beginning of Corona. Really has been doing great. And if you look at the dollar, I'm not sure if this, yeah, I guess here. No, never mind. Maybe S&P just. Oh. This is not a good example. Sorry. But yeah, whenever the dollar is not doing as good, yeah, I forgot. Gold and dollar opposite each other. Okay. This one is series bonds again with an on an index. So these opposite each other as well. So that's pretty much it. I should have done some more research into, especially the later part of this video. But yeah, it is what it is. So I'll work more on the next video.